Welcome to Bellentic Edge, conversations that matter in private markets. I'm your host, Kasper, investor, entrepreneur, and founder of Bellentic. On this show, we explore the people, strategies, and ideas shaping private markets today, from GPs building tomorrow's funds to LPs allocating in a shifting landscape. This episode is brought to you by Orca, an AI-driven compliant platform connecting the right GPs with the right LPs, smarter matches, faster decisions, and better outcomes. On this episode of Bellentic Edge, I sit down with Alex Branton, CIO and founding partner at Nodem Capital. We explore one of the biggest questions facing private markets today, liquidity. From NAV lending and secondaries to portfolio construction, private credit, and valuation discipline, we unpack what it means in today's environment for LPs and GPs. Is NAV lending a sign of distress or simply another tool in the liquidity toolkit? And are investors focusing on the wrong risks? Alex is CIO and founding partner of Nodem Capital, a provider of portfolio-backed liquidity solutions across private markets. Previously, Alex was with Sturgeon Capital and Cambridge Associates, advising and managing capital for institutions, family offices, and global investors across private equity and venture capital. Welcome to Bellentic Edge, Alex.
Thanks, Kasper. Thanks for having me.
Alex, you've sat on the allocator side at Cambridge, the GP side at Sturgeon, and now at the liquidity provider side, if you like, at Nodem. Which experiences most shaped how you think about risk and liquidity today?
Yeah, good question. So at Cambridge Associates, essentially we would help clients who had portfolios of fund positions make sensible decisions about their long-term asset allocation, so adjusting valuations, for example. But on terms of liquidity, we'd run the spending models, deployment models, go through various different scenarios about what could happen. And I think the lesson there was more liquidity risk isn't about the quality of your assets as much as really having realistic expectations, judging that asset-liability mismatch. On the Sturgeon side, when I was a GP on the private equity side, really what you're learning is how expectations of LP and GP liquidity can differ. So, for example, a GP holding a position for 7 years because they know and love the asset and really want to maximize an optimal exit may look like failure for an LP that's expecting a 5-year holding period. And really, I guess Nodem and what we're trying to do here is really offer strategic bridging facilities where there are mismatches for whatever reason it might be.
And on Nodem, for listeners who may not be that familiar with you, where do you sit in the private markets ecosystem and what problems do you solve, and you just alluded to it, for LPs, GPs, and asset owners in general?
Nodem is a NAV lender, and that means we provide loans against diversified portfolios of private assets. We're not pushing any debt down to the underlying businesses. So what does that mean? Private equity fund raises equity capital and it will use leverage on a deal by deal basis to buy companies. That debt shifts to the company. The equity in those companies, so sort of the value less the debt, that combined is your fund NAV. That fund NAV effectively is collateral that could be used for another loan on top of that. And it is used by private equity funds predominantly where they have somewhat levered portfolio in order, rather than raise more equity capital from their LPs, they can get cheaper capital, i.e. a NAV loan against that NAV in order mostly to do bolt-on acquisitions. In theory, they could use it also to fund distributions. It could use it to fund all sorts of things, accelerate management fees. But the most common one is to accelerate fund management. The market's around 100 billion in volume. You get banks that do some of the larger transactions, lower LTVs. You get the likes of 17 Capital who will do $200 million facilities to a very large private equity buyout. And Nodem sits there really servicing mid to small private equity funds and family offices, those that are holding diversified pools of illiquid assets that are underserved by the broader market, wherever there's a liquidity mismatch. So you're a family office with a maturing portfolio waiting DPI. You want to keep your vintage year diversification, keep investing. You might want to lever your older LP stakes ahead of DPI that's expected in the next couple of years to keep investing, or you may be able to take advantage of an opportunity to buy a distressed secondary, whatever it might be. You need capital right now. You don't want to sell that into opaque and difficult secondary markets, and sometimes it's easier just to borrow in a modest way against that.
I think you're providing a service here to a number of different counterparties. But if we zoom in on the GPs for just a second, how concerned should I be on the back of an era where GPs, by and large, have been paying up on pro forma EBITDAs that stretched way into the future using one-offs? How concerned should we be as LPs applying leverage at the NAV level? Now, you'll probably be fine. You've got an LTV and presumably the underlying assets are healthy. You would do the due diligence. But as an LP, should I be running for the gates when they start doing this?
I think there are good reasons and bad reasons to do it. Bad reason would be that you've already levered up the portfolio to a maximum level. The companies are incredibly weak, and in order to bail out the underlying companies that are heavily levered and maybe facing declining revenue, this is seen as like one last Hail Mary in order to raise capital at the fund level to push down to fund those businesses. I don't see any NAV lenders funding anything even close to a transaction like that. As a NAV lender, you would come in, you would look for modest amounts of leverage at the underlying level, and you would look for a kind of a strong use case. So to answer your question, sometimes you should absolutely be highly concerned and scrutinize the GP and why they're doing it. But in some instances, if they've got a strong portfolio, they're 100% drawn you in year 6, and there turns out that one of the other shareholders in your best anchor company for some reason needs capital quickly, and you have the ability to buy shares at a discounted rate. You could get capital from a NAV lender at 350 basis points above a rate at a 10% LTV, and you can buy this thing that is at a steep discount and can add real value. That makes sense. But where there's a weak portfolio and this is being used to either cover up the cracks or to accelerate money out of a portfolio that's worth significantly less, but that's really an underwriting skill. The ILPA guidelines on NAV lending are relatively clear now. Really, it should always be taken to the LPAC in order to scrutinize the use case. Why is it being used? And then often there would be a broader consent required as well. Particularly many of the older funds don't have in their documents the ability to use facilities like this. So some amendment needs to be made. That said, more and more it's becoming common. So there are very much good and bad use cases for this.
So maybe stretching the concept here, but would it be correct then to say that if you're uncomfortable with a NAV loan at the portfolio level, you should probably be uncomfortable with the GP in the portfolio in the first place and may not want to be there to start with?
I think the more concerning thing is anything that really encumbers your underlying companies. That's how you destroy value. So if you've over-levered the underlying companies, that's destroying value. Whereas, modest NAV loan at the portfolio company against a modestly levered portfolio doesn't really add any kind of cascading risk. It's actually, you should be more concerned about the companies underlying it being wiped out by the lending there, and even then it's part and parcel of the strategy. So again, you really have to scrutinize it. Everything can be done well or badly.
The opacity, of course, for LPs also arise because we tend to be at arm's length and we tend not to have the toolbox to work our way through these things and fully understand them, and we cannot do it at the speed that's often required to have a meaningful say on do we like it or not.
Yeah. And I'd say NAV loans have been seen as one of the more controversial things that an LP can comment on, the same way capital call lines were originally, the same way that certain of the LBO structures were as well. There seems to be kind of an adoption curve here. And we're certainly still in a phase where it's growing rapidly and the frameworks are now coming up to match it. But I can totally see without that transparency how it's hard to make a decision on it and why it could be perceived as scary.
Moving back to risk, I think private markets as a whole spend a decade assuming that liquidity would eventually arrive. Hope is eternal. Has the industry, do you think, been underpricing liquidity risk all along? Because it is an illiquid asset class where we've bent ourselves out of shape to try to create what the cynic in me would describe as synthetic DPI, synthetic liquidity.
I think it's important to be precise about what was maybe underpriced. I think the assets themselves weren't the problem. It's more maybe the industry underpriced that cost of time. And of course, it really goes back to when interest rates are at zero, the illiquid positions help us have no opportunity cost in that sense. You can wait indefinitely. And most of the capital was raised during that era, where if you're at a 5% risk-free rate, then every dollar that's not being distributed is not earning something elsewhere. And that repricing is enormous and still happening. And I think private markets require that patience by design. I think liquidity tools like ours are emerging now in response to it.
Following on from that, what should an LP be doing now? What should they be looking at in their portfolio? What's the first thing they should take away from this and go home and do?
We alluded to it earlier. Things can be done well or badly. Some GPs perform well, some don't perform well. I think understanding why they're doing what they're doing. Is the underlying genuinely a very strong company that they're trying to maximize value, or is that GP particularly bad at producing DPI? Producing DPI is a very different skill to investing capital, and often a more difficult one. Is deploying the capital is only one part of the picture. And I think what proactively you can do is, I think that to a certain degree, you have to punish poor performance in your GPs. But to do that, you really need to look through your portfolio and understand what is happening and make a judgment call on that. I think if you are really badly in need of liquidity or there are some pressures there, I think a NAV loan should be considered, in the sense that, at a very modest level, there is value in your older holdings that can smooth that cash flow for you. You can, if you need liquidity, can also approach secondary markets where liquidity is really concentrated in a real handful of private equity funds, private equity backed names, even worse in the venture side where 85% of the liquidity is in 20 names, I understand. And so I think really scrutinize your GPs. Why are they doing what they're doing? I think if you need liquidity, do consider a NAV loan alongside secondaries. Really look at all your options when it comes to that. Another one would be a continuation vehicle. Again, why are you doing that? Is there no market for that? Or are you trying to get management fees for a longer period of time? Or is it a very, very valuable exit route? And the specifics matter in all of these things, and so it's always scrutinized. Don't take things blindly. Really do interact with the GP.
We're back at, as LPs, we pay GPs in principle for three things: buy something, hopefully at a good price, do something with it, hopefully something that improves value, and sell it. And LPs should now be triaging their portfolios for the GPs that are doing that and look to get rid of somehow the ones that are not doing that. Is that fair?
100%.
We're going to jump a little bit more into the private market liquidity conundrum here. There's a lot of discussion today about gating, delayed exits, continuation vehicles or CVs, NAV lending, and what some people are calling the SaaS apocalypse or venture reckoning. From your seat, what's beneath the actual headlines? What's going on?
The market is clearly genuinely slow. Holding periods are 7 years up from 5 over the kind of the teens in terms of the 2010 to 2019. There's a huge number of backlog. A lot of this is driven by the interest rates we mentioned, and now the unwinding of that trade. You've got secondary markets that probably represent around 1% annually of outstanding unrealized value. So I feel like the market has been focused very much on primary capital, deploying capital into kind of low interest rate environments. And the market is now responding by raising more capital, dedicated secondary vehicles. There are innovations around, I'm sure we'll get into it, evergreen vehicles to kind of inject more capital in some instances into the market to buy those assets. So the market is trying to rationalize itself to a certain degree. On the SaaS apocalypse, I think that what people often conflate there, whilst there are some concerns, I think the headlines tend to be more about the asset liability mismatch of the fund structures, i.e. BDCs that have wealth capital in that are kind of shooting to the door whenever there is a headline about the SaaS apocalypse. Whether or not it's real or not kind of matters less. It's more there's a run on the bank effectively in these structures, and they're now being gated. So I see less systematic risk right now, though you have to keep an eye on it. I see more concern about the liquidity mismatch of these kind of evergreen type vehicles. So in short, there has been a huge run up in primary fundraising and deployment on the private equity and the venture capital side. It's taking way longer to exit those investments. There's a huge backlog that will take, even if you are average exit volumes 8+ years to clear out. So this is taking a lot longer than everyone thought. And you should adjust all of your assumptions and model as an LP to take into consideration huge slippages in the durations you expected going in. But I don't see myself from where I'm sitting. I see pretty conservative. I mean, I sit in an asset class that's only like 0.3 kind of correlated to direct lending in that sense. So it is quite different. But I see all of the portfolios like an LP. I'm underwriting every asset class you can possibly imagine as an LP in this, but underwriting, is that NAV real? What's in that in a view to lending? And I need liquidity within 5 years for my strategy to work. So I have to be very conservative, but there are some areas that are to be concerned, but I think broader systematic risk, less so. I
want to go a little bit deeper on NAV lending or NAV financing. It's new, right? So I think some people immediately interpret it as a sign of distress. How do you, as an LP or yourself, how do you distinguish between sort of productive liquidity management, which you're saying is one use, and then where there is genuine portfolio stress? And you alluded a little bit to it on the underlying companies, but again, as LPs, that's often not a luxury we have to be able to drill that deep down, nor do we have the time or necessarily the toolbox.
From an LP perspective, without access to data, it's going to be tough. I can only really speak about it from my perspective. So let's say productive liquidity management, really what that looks like as an investor is trying to access capital against what is pretty clearly a performing portfolio with a a pretty clear plan as to how that gets paid. Often there's an M&A process in action. There's an IPO being filed. There's a real tangible, not just a tenuous promise to sell a minority stake in a company that you know will be a nightmare to get hold of. There is some kind of monetization event on the horizon. It's not just a blank, we hope something will happen in 5 years. I think the comfort with NAV lending really comes with some visibility about when it can be repaid. And that's something we require as well. So if that's not there, it's a time to be worried. I think genuine stress, again, is often relatively easy to identify. It's pretty obvious that there's no other option. So they've gone and tried to sell things in the secondary market, or they're overvaluing things, or whatever it might be, and they've basically failed. The distributions have dried up, and a NAV loan is seen as a kind of a way to distribute something to investors, maybe in a portfolio that's worth significantly less. To be clear, only about 10% of NAV facilities are ever used for distributions. And of those, it often doesn't look like that. I see NAV lenders tend to be pretty conservative, and they're really trying to smell something like that. But as I said before, as an LP, if you're on an LPAC, you should really be scrutinizing why is this being used. And in some instances, the question is, look, this is ultimately pretty cheap capital that we can use for kind of accretive purposes. And we've got multiple ways out of this trade. Sometimes there's even some undrawn LP capital that can be used to repay it, or at least partially. There's certainly like 1 or 2 liquidity events that are coming. In some cases, there's dividend, whatever it might be. And it's in the interest of all parties for this to have a pretty clear payoff. It's just that payoff is not right now. It's in 2 years. That's where the value comes.
Going back a little bit to one of our earlier points, there's a lot of the private market portfolios that we're looking at today, and that I'm sure for you is eligible for NAV lending. They were built in an era where capital was abundant, interest rates were practically zero, and liquidity assumptions were generous in terms of everything gets refinanced every third year, distributions come fast and frequently. What then breaks down in portfolio construction when the debt, so to speak, stops being effectively free?
Good question. What's clearly happening is the J curve extends massively, i.e. that period of time for the value and the distributions really to come. So yeah, capital is cheap, deploying quickly, markups early, higher interest rate environment. Clearly it slows down. Also the amount of leverage you can use. So it's not only the interest rates up or down, it's actually the amount of equity that you need to put in is far higher now for a similar reason. You have, again, the opportunity cost of that illiquidity just becomes more visible as well. And I think the duration that you have to wait now for that capital to come in, you have to adjust your returns to control for that as well. And that opportunity cost, what are the illiquid equivalents of direct lending or private equity in some instances of public equity? I think a lot of people have forgotten that there are public markets out there as well that can offer a valuable counterweight on a portfolio construction basis. And maybe the ultimate conclusion ends up being, what we might need to kind of slow down our deployment or actually undersize maybe private equity versus what it was. And there are some periods where lower interest rates are there and it's a better environment, and there's some that aren't. That's a very kind of nondescript kind of answer to that. I think you're saying what is the effect for portfolio construction? Maybe those are the conclusions. Cutting down, modeling far longer distribution cycles.
As it filters into, for LPs, things such as cash management, which arguably the institutions should have a better grasp of versus your private individuals. So now we get into things GP should be considering, which is counterparty risk. No distributions coming. Can people actually meet their capital obligations? Have you reached a point where some of the vintages need to be re-underwritten, so to speak, using different assumptions?
I find this is something that comes up a lot, and obviously it's critical to what we do because the V in the LTV is the NAV. It's literally my job is to re-underwrite fund NAVs, basically, is my day to day. I am, I'd say, pleasantly surprised by the higher quality GPs, I really do feel are marking portfolios fairly. Whilst there's huge amount of discretion on the GP side, for sure, in terms of the way that these things are marked, I find that the best GPs are being pretty proactive in terms of marking portfolios accurately and really articulating what is happening. And I think that's another signal for you as an LP. If people are not marking things down, often you can compare between funds, the same company being held. If it's being marked in a different way, that is a sign of a weaker GP. So if you have a strong portfolio of GPs, you should always double check it and ask what the comps are, ask what the inputs that went into the audit or the management accounts that came up with that statement. But ultimately, I think there's less concern if you're in higher tier GPs. I think if you're in less well-known GPs, weaker GPs, maybe sometimes emerging managers that might not have that same discipline in it. Sometimes you do have to take things into your own hands. If you have a fintech portfolio that is being held at 2021 marks or whatever it might be, you might need to look at what the comparables are on the public markets and apply your own haircut to it just for your own sanity. But I would say that's a sign of a weaker GP and probably one you might not want to re-up into. They should be erring on the side of caution. But I've been pleasantly surprised. I thought it would be worse than it has been going into Nodem. A couple of years ago, we really started digging into this. Having been a GP before, I've now seen a much broader range of funds. And it's not quite the disaster that people make it out to be.
As we all now head home after listening to the podcast to triage our portfolios, that's actually a bit of good news, that the best GPs out there are doing what they're meant to be doing, and we can rely on that. The bad news to take away from this is that there really is a lot of work ahead for the LPs in terms of figuring out what's what in their portfolios, and then we have to ask ourselves the questions. Do we have that toolbox as LPs, or should we be speaking with professional advisors to help us on that? Moving on a little bit, Alex. Many investors view credit as a safer part of private markets, a little bit like the public markets. I grew up in leveraged finance and always heard the assumption from big investors, but that's easy, it always comes home. Today, the cracks are starting to appear. It might actually be the very mechanism through which the stress is being transmitted into the portfolios. In that context, how do you think about the relationship between liquidity, leverage, and credit risk today?
Yeah, I think the thing that people misunderstand a little bit about it is the mismatch between the liquidity promises of fund managers, really, and the actual liquidity of the assets they hold. Direct lending, it's gone from 100 billion or so to 2 trillion plus over the decade. To raise capital at that pace, they've had to go now to wealth channels, ultra high net worth individuals, offering innovative structures like quarterly redemption periods and things like that introduce almost a kind of bank style asset liability mismatches. And actually, if you look through these portfolios, the default rates, yes, they differ, still not, for me anyway, at a level that caused major concern. Some of the biggest blow-ups have actually been banks themselves doing it directly. And so I see a lot of the concern right now is really, if you look through it, it's around that asset liability mismatch as opposed to the underwriting. What I would say is that if there are broader, major fundamental problems with direct lending, that's a private equity problem as well, because there'll be, as you've seen it with a few kind of big kind of blow ups recently, the lender is the last person can at least get the salvage value of it, but the equity gets wiped out. So this is all intertwined for the various reasons we mentioned. I personally don't see any massive kind of systematic risk at the moment. I see that there is some competitive laxity on the direct lending side as it became more and more competitive. And in some cases, you would have to win a deal by having looser covenants or whatever else. But more broadly speaking, I think there's certainly some concern. I don't see any systematic risk. And I'd say if there is systematic risk, we've all got bigger problems, I think.
Another piece of good news to take away from this. Along this line, what are the sophisticated investors getting right or wrong about private credit at this stage of the cycle? And here I'm also thinking that we certainly have a financial focused newspaper, Your Way, that seems to be on a almost holy crusade against anything related to private debt.
I think as with everything, it's lumping all the GPs as equivalent quality and doing things. There are bad banks, bad lenders, good lenders. I think really differentiating there is important as opposed to a blanket, this is bad, this is good. I think there's also a tendency to conflate first lien direct lending to a single software company to even someone like a Nodem that's investing a 15% LTV against a company with 80 companies in it, with a hefty equity cushion in it, or whether it's NAV lending. NAV lending is another one that's had a lot of bad press, but if you look through it, actually, they're saying that it's manufacturing DPI. That's a very minority kind of use case. There's an implication it's somehow encumbering the underlying portfolio companies. It doesn't. If there's a theme, do your own work to really understand some of this as well. And again, on the private credit side, really, the issue is more the structures that have been invented now to suck more capital into the asset class that is causing the issue as opposed to the underlying. So there's always a grain of truth in everything there, but it's not the disaster that everyone said.
Alex, what happens next? If distributions do remain muted and exits do stay slower than expected, what kind of second order effects for LPs and for GPs? What's going to happen over the next 3 to 5 years?
DPI is consistently held up as the primary factor in when to kind of re-up into a new manager. And I think you'll just see managers that are unwilling to create TBI for their investors. The investors will just vote with their feet. And so you'll have a concentration of investment going to fewer firms that have proved themselves actually able to create. The part of the product is that you get your money back at some point as well. You haven't delivered. And so the second order effect will be, I think, a large number of managers probably fail in that and slowly kind of wind their portfolios down. You'll see capital accrue to those that have achieved that. And I think you may, in many cases, there are investors that really invested very, very heavily into the asset class over the 2021 period that will likely slow their pace of commitments or dial down their private market exposure slightly, in the knowledge now that they need to be baking in 15-year cycles into venture capital or 8-year cycles into private equity. I think it all goes back to the Cambridge Associates. You're modeling your portfolio as to what can happen. You're stress testing those situations. The assumptions are just now entirely different. So if you bake that in there, I think the model will split out what I just mentioned in terms of the actions.
We're also to some extent back at the toolbox that you and I grew up with, me in a previous life, you at Cambridge, where we invest consistently over the long term through cycles, knowing full well that some vintages will outperform, other vintages will underperform, and there will be prolonged stretches of illiquidity. So it's nice that toolbox, even if maybe forgotten for the moment, is not irrelevant.
Yeah, absolutely. And of course, if you are cash rich now, you can take advantage of some of these dislocations. There are people that need liquidity. You can buy those assets. There's certain venture assets that are pricing easily 50% discounts. There are some private equity that are pricing down as well. So, being proactive, these things that can be negative to others can also be positive for others.
Alex, we've talked quite a bit about the risks. I think that's also where the concerns are for a lot of LPs. But what excites you about this opportunity right now? Maybe also because the broader market is actually quite worried, not just newspapers and so on and other pundits, but LPs, GPs, etc.
Good question. So taking private credit again as an example. So the narrative, as you mentioned, is negative. The result of that, from my perspective, for example, for my investors, is that we're seeing wider spreads, lower LTVs, higher quality portfolios in many ways, because you have people like banks that are retrenching from the space the way they did before. So sometimes what is perceived as negative can be good for someone that's allocating into a strategy like ourselves. And I'd say, again, going back to it, what excited you, if you're sitting now on liquidity or have access to liquidity, sometimes even through a NAV loan, and you know how to originate kind of either underappreciated or those that are in need of liquidity, you have an opportunity to have a real structural advantage right now in this market. And I think that is pretty exciting. You still need to be extremely choosy about what you do within that, but that represents a huge opportunity right now. And you can see that in the reflection of the kind of growing secondaries market, which is fragmented, but represents huge opportunity.
So we're back at what you just said before. This is actually a good time if you're a cash-rich buyer sitting at that intersection of the market, which to some extent Nodem actually then does. You can afford to be picky, you have the right toolbox, you understand the underlying assets, and you can price them and possibly do quite well from that.
Exactly.
Alex, we're almost at the end of it. We've time for a couple of quick fire questions. What risk are people talking too much about in private markets today, in your opinion, which is not really relevant?
I think the valuations, I find the best GPs, again, being proactive in that, I think fairly marking their portfolios.
And then what is the risk that almost nobody is discussing today, that they should be discussing?
I think the asset-liability mismatches should be discussed more in these new innovative kind of democratizing vehicles. I think that there's a place for them and they are being discussed, but I think being conflated with things that are less of a risk, like the underlying underwriting, for example.
That's an excellent point. 5 years from now, what do you think investors will look back on and realize they misunderstood?
I think the undervalued the benefits of public markets to a certain degree, and that there is a reason that the transparency, the efficiency, the price discovery, capital allocation, there is a genuine value to it. I mean, there are a lot of companies that have chosen not to take that on, and there is a risk that breeds things that would have come to the light far quicker in public markets. I would go down that route probably. I love private markets, but I think maybe public markets have been dismissed too easily.
So you heard it here in Bellentiga Edge, a private markets podcast. We should be looking more at public markets. That's an excellent takeaway.
Or at least, loving it a bit more. Yeah.
Maybe just on a serious note, just applying a little bit more scrutiny, but often that's at the level above the investment team. How do you set your overall asset allocation and portfolio construction? Alex, this has been an absolutely fascinating journey down NAV lending. We talked about things such as liquidity risk is about realistic expectations and differs from GP to LP. We talked about NAV lending can serve multiple purposes and parties. There are pros and cons. The importance of the LPAC actually understanding this. We are also early on, and I think that's really important to note, in an adoption curve. So everybody is still learning. There's a lot of education to be done. Maybe not be fearful, but just at least be conscious of what's actually what in this. So I like that the GPs have to produce DPI, which is very different from investing. And I think that is actually something that has been happily forgotten over the last cycle, at least maybe a decade and a half. So less systematic risk I liked as well, but liquidity risk obviously is much easier to manage than if it's systematic risk. So that's a positive to take away. Important also for LPs to think about the J curve actually extending. What does that mean for how they think about portfolio construction and cash management? NAV lending as a re-underwriting tool, something that I think we should probably all be doing, whether or not we then provide a NAV loan or not. I think re-underwriting the GPs we've invested in, the GPs re-underwriting the assets is particularly important. Another piece of positive news I took away from you, the best GPs are marking their portfolios correctly. And one final takeaway, and I think it's really positive for those who are cash rich, hey, this is a good time to be cash rich. There will be some nice pickings out there if you have the toolbox. Alex, absolutely fascinating. Thank you for being on Valentic Edge today and sharing your insights with us.
Cool. Thank you, Kasper.
And thank you also to our listeners for tuning in to this episode of Valentic Edge. We will be back soon with another episode. Thank you for tuning in to Valentic Edge. I hope you enjoyed the conversation. If you did, please hit follow on Spotify or Apple, or subscribe on YouTube. And please share this episode with a friend or colleague. Got feedback or questions? I'd love to hear from you. Connect with me on LinkedIn. This episode was brought to you by Orca, helping GPs reach the right LPs and LPs discover the right funds. Learn more at valentic.com/Orca. Thanks again for listening, and until next time, stay illiquid. Finally, a small but necessary disclaimer. The views expressed in this podcast are solely those of the hosts and the guests and are provided for informational purposes only. They do not represent the views of any affiliated organizations, employers, or entities. Nothing discussed should be construed as investment, legal, tax, or business advice. Any reference to specific funds, companies, or investment strategies are purely illustrative and do not constitute an offer, solicitation, or recommendation to buy or sell any security or financial instrument. Listeners should consult their own professional advisors before making any investment or financial decisions.